What's up, guys? Welcome back to the channel. I hope you're doing well today. And in today's video, we're going to talk about the problem with dividend stocks. As always, before we go any further, I am not a financial expert. I'm not a financial advisor. I'm just some guy on YouTube. So this video is for entertainment purposes only, not financial advice. And I'm going to be honest with you guys up front in that I am relatively new to investing in the stock market by picking individual funds. And I've been doing research, and I feel like the debate presented to me, and presented to you probably, is you have to choose between either growth stocks or dividend stocks. And when I made my video a couple days ago about 10 stocks that I am buying now, I was trying to find a combination of two. That just seemed like the safe option. However, the more research I do, the more I realize that there's actually no difference. Whether it's growth or dividends, these are actually the same thing. The reason why is because money can neither be created nor destroyed. When you're paying the share price for a company, you're paying for its valuation. Whether the share price goes up because the company reinvests its profit in the company, or whether it pays it out as a dividend, it's actually the same amount mathematically. And the reason I'm making this video today is in response to these other investing YouTubers who constantly post videos about dividend stocks. And I think because it feels like you're earning an income from these dividends, that it is really appealing and it gets a lot of clicks, gets a lot of views. However, the math for these guys, it just doesn't pan out. And I've watched their videos, I've listened to them, and they say things like dividend stocks are true passive income, getting paid while you sleep. Well, first of all stocks are passive income. If you appreciate the capital in a stock, that is, basically passive income. You have to sell the stock in order to make it final, but there's really no difference between your stock appreciating 2% and then receiving a 2% dividend. These guys also champion dividend stocks because they say profits are a matter of opinion, dividends are a matter of fact. Yes, it's true that companies in the past have inflated their books or made themselves look more profitable than they actually are, whereas when they pay out a dividend, that is a fact. They earned profits, they gave their profits to their shareholders in the form of a dividend. Yes, companies could be defrauding their investors by inflating the books, but I feel like that is an exception, not the rule. So I don't want to invest on that operating assumption that I'm being defrauded. These guys also say that dividend stocks are well-established companies and that researching growth stocks maybe takes too much time. Yes, that's true that companies that don't offer a dividend traditionally are still growing. They want to reinvest all profits in the company in order to capture a larger market share. Usually when basically they're saturated and they don't feel like their company can innovate or grow much more, that's when they traditionally start offering large dividends because they say, hey, we don't really need to invest more in the company now, so we're going to go ahead and take our profits and just distribute it to the shareholders. And then they also say that dividend stocks fall less hard and recover faster during recessions. This could be kind of like a chicken and the egg argument, though. Either well-established older companies are the ones that pay dividends. Are they recovering their share prices faster because they offer dividends, or are they recovering faster because they're older, more well-established, more resilient companies? Correlation does not equal causation in this fact. Now, because I am new to picking individual stocks, in the back of my mind, I am always realizing the opportunity cost. You should not be picking individual stocks unless you think you can beat the market average. You have to ask yourself, would I be better off just investing in a low-cost index fund that tracks the general market? If you do that, if you just invest in the S&P 500, you invest literally in the entire stock market proportional to their market share cap. And the S&P 500 is great. It averages, with dividends reinvested, it averages 9.8% over the long run. If you just buy a low-cost S&P 500 index fund, you can expect roughly to earn about 9.8% in the long run. I can go ahead and show you the math real quick of a specific example. This is Vanguard's mutual fund, which is the S&P 500. You can Google it. It's Vivafax, VFIAX. They have an ETF equivalent, VOO. And you can look at what is their annual total return. When you invest in this mutual fund, your share price, your valuation increased 26% in 2009. It was down 36% in 2008. Up 15, up 32% in 2013. There was a slight decline in 2018, but in 2019 it was up 31%. And let's go ahead and look at the last 5 years of performance for this fund. Let's say on January 1st, 2015, you had invested $1,000. By the end of the year, December 31st, you would have only made $13.60. But the next year, you'd be up 134, 381, down to 320, and then up to 735. So a $1,000 investment over a 5-year period in this fund, the S&P 500, would have yielded you $735. If you do the math and average out how much you averaged over those 5 years, it was 11.7%. Yes, it outperformed its historic average of 9.8%. But obviously in 2020, we're having a bit of a downturn, so there's a market correction. So we'll get closer to that median of 9.8. Something to remember though is that even when the economy was good, the S&P 500 did not double within 5 years. So a rule of thumb that I use when evaluating the capital appreciation of a stock is, did their share price double in the last 5 years? If it did, then I 100% know that it outperformed the market average. So if a simple low-cost index fund averaged 11.7% the last 5 years, were there any dividend stocks that paid you out a dividend of 11.7% the last 5 years? And the answer to that is no. There were no stocks that gave you an 11.7% dividend payout consistently over the last 5 years to overtake the S&P 500's average, which means you have to look at dividends and capital growth in the last 5 years to see if your investment beat the market average. If your objective is to beat the market average, you can do it with either dividends or growth, or dividends and growth. It doesn't matter if you beat it by 100% dividends or 100% growth or any combination of the two. But my point is that nobody has beaten the market average with just a 100% dividend stock. Additionally, when it comes to the debate of growth stocks versus dividend stocks, mathematically they're the same thing. Let's assume there is an identical company, or a company living in two different timelines. So we have company 1 and company 2. If you were to invest $100,000 in stocks for both of these companies, and let's say both companies appreciated 20% in value within 1 year. Now, their future profitability projections are the same. These are the identical companies, except one company is going to pay a 10% dividend, and the other is going to reinvest that profit back into the company, retaining its value. Both companies appreciated at 20%, but company 1 pays a 10% dividend. Mathematically, it's the same. I oversimplified it for this example, but you're going to hold, after 1 year, $110,000 in stock, and then you were given $10,000 in dividends, whereas in the other company, you just, once again, hold $120,000 in stock. I'm not going to go into the complexity of taxes in this video, but you actually have to pay taxes on that dividend payout if you don't reinvest it. Whereas in company 2, when you just have capital appreciation, you get to choose when you sell shares, and you then pay taxes on your capital gains. In the company 2 scenario, there is nothing stopping you at any point from selling your shares and then just saying, hey, I paid myself a dividend. Let's say you owned $100,000 in stock that appreciated at 20%. You then sold 10% of your stock. You basically just paid yourself a 10% dividend. When figuring out the value of your investment, it's always the number of shares multiplied by the share price equals the value. It doesn't matter if it's 10 shares worth $100 each or 100 shares worth $10 each. $1,000 is $1,000. So let's come back to this and think about it again as dividends plus growth. If you're trying to beat the market average, and the market average the last 5 years of 11.7%, you can do that by either a growth stock that got you 11.7 or more, or a dividend stock which got you 11.7, which we agree doesn't exist. Or you can do some combination, a dividend stock of 5.85, but then you also need capital appreciation of at least 5.85% a year in order to beat that market average. And once again, you can do any combination, 5 plus 6.7, 6.7 plus 5, but combined, you need to outpace the market average of 11.7. A lot of these YouTube channels like talking about the Dividend Aristocrats. If you don't know what a Dividend Aristocrat is, it's a company in the S&P 500 that has paid and increased its base dividend every year for at least 25 consecutive years. This is kind of an exclusive club that companies deliberately chase because they want to be on the list, because people purposely invest in these companies because they're on the list. However, this is not a good criteria. There are companies on this list that have beaten the market average the last 5 years and have severely underperformed the last 5 years. The first one we can talk about is McDonald's. This is a company that I've personally chosen to invest in. When you look at their share price from 5 years ago, 97.8, even today, with the downturn, it's at 184. When you do the math, and it's x to the fifth power, so if you just take what the current share price is divided by what the share price was 5 years ago, and then take it to the 1/5 exponent. That's the same as the fifth square root. A little complicated, but I assure you it works. You can figure out what did they average in capital appreciation the last 5 years. And McDonald's averaged 13.5%. This is still a growing company, in addition to paying a dividend yield of 2.71%. So anyone the last 5 years who has been invested in McDonald's, they beat the S&P 500 index fund. Next example is Ross Stores. This is a discount store company. When you look at their share price from 5 years ago to today, it actually averages exactly 11.7%. But this is counting the dip where it lost basically 40% of its valuation. So I'm going to go ahead and give this company a pass. But even if it averaged exactly 11.7, you then factor in the dividend yield of 1.27%, and this company beat the S&P 500 index fund the last 5 years. Now, will McDonald's and Ross continue to beat the market average the next 5 years in the future? I don't know. I can't predict the future. But I like focusing on companies that have performed well in the past, that have tried to grow their share price, in addition to offering a nice dividend yield. It's a combination of both. The next stock we can look at is a classic dividend stock, and this is ExxonMobil. For the last 5 years, the share price has hovered around 80. And yes, it's gone down recently because of what's going on in the world, and basically all of the energy stocks have been doing bad because Russia and Saudi Arabia are not getting along. So let's go ahead and say that it's been completely flat. Now look at the dividend yield. The dividend yield is really high. It's over 7%. People look at that dividend yield and they get excited. However, there's been virtually no appreciation in capital in share price for this company the last 5 years. Meaning that if you're investing in ExxonMobil the last 5 years, there was an opportunity cost in not investing in an S&P 500 index fund. So you just lost. You didn't lose money because the dividend yield is still netting you a positive amount, but there was an opportunity cost. You net lost money by not being in a simple low-cost index fund. Likewise, you can look at additional dividend stocks on the aristocrat list like AT&T. This is a company I hear other YouTubers talking a lot about, and its share price fluctuates up and down. It's been doing it for the last 5 years. Basically, when you jumped on this stock, if you jumped up here, you would have been losing. If you jumped here, maybe you'd be up. Yes, it has a really high dividend yield of over 6%, but you're not beating the market average. If you're investing in this company for its large dividends, there's an opportunity cost there, and you're net losing money. A company like 3M is exactly the same. If you had gotten in here, you pretty much, for a capital appreciation, would have been breaking even. If you bought around here, then you just would be losing money. And then there are stocks on the aristocrat list that have been doing very poorly the last 5 years. If you look at a company like Walgreens, yes, it has a 4% dividend yield, but when you do the math of where their share price was 5 years ago, where their share price is now, you have net lost 13% a year. So you're losing 13% to gain 4% for a net loss, roughly. This is very rough math, but a net loss of around 7 or 8%. So once again, jumping in a stock just because it has a good dividend yield, when you're ignoring what the capital appreciation has done, that is how you lose money. I went through the whole list, and probably the company that has done the worst the last 5 years is Franklin Resources. This is an investment management company, ironically. And yeah, their dividend yield is over 6%, but when you look at what their market appreciation has done, it has lost, on average, 19% a year the last 5 years. And it's important to realize that when you buy these stocks and you hold these stocks, eventually you have to sell them. And when you sell them at a huge loss, it doesn't matter what the dividend payout was, you're not going to be net profit in the long run when a company is doing this poorly. Now, once again, I cannot predict the future. A company like Franklin Resources, their capital appreciation might rebound, it might skyrocket, they might do amazing, and you won't lose any money in the long run from capital appreciation. But once again, there was an opportunity cost, and if you had just been in a low-cost index fund the last 5 years, you would have done vastly better than being in funds like this. So the point I'm trying to make in this video is that capital gains, capital appreciation is important. I watch these other YouTubers and they completely ignore it. They just say, oh, this is a good company, a well-established company, the share price holds, it has a nice 5, 6, 7% dividend yield, but it doesn't outperform the market average. You're losing money. And in the event you're just someone who likes seeing, cash randomly show up in your account every quarter, then you can go with Vanguard's Total Market Index Fund, VTI. This is the ETF equivalent of their fund, and this has a dividend yield of 2.46%. Yes, that's not 3, 4, 5, or 6 like some of the other stocks I showed you, but you can look at the share price, what it's done the last 5 years. It is the market average, and you're much better off just buying this ETF than you are most of the stocks that I showed in this video. And my final word is do what you want. I might get some nasty comments in this video because people are really attached to their dividend stocks. But if it's not performing the market average, there's an opportunity cost there that you're choosing to accept. But once again, it's people's money. They can do whatever they want. You do you. Okay guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I post about finance topics. I'll do a couple more about stocks and investing. And if you have any questions, leave me one down below. I know I'm going to get comments on this video. And until the next video, take care.